get started. Franco was actually added at the request of many of our Alhambra students who, when I talked about this this day workshop, they said, we should do something on short sales. So, I asked Franco to come. He's come as a favor to me. I've known him for a long time. He's been with a company called the Short Sale Matrix Processing since its inception. And he's been their senior negotiator basically since the company started. Franco and his team have successfully closed this is mind-blowing, over 600 short sale transactions. So he's extremely tenured. He's done a lot of business. He recently closed a multi-million-dollar transaction in Newport Beach where the home was encumbered with 6 liens. And when you're selling a property that has that many liens and it's a short sale, it involves negotiating, of course, with each of the lien holders. Franco Rodriguez, thank you.
Thank you. Good afternoon. How is everybody today? Everybody awake now? Had a little break, a little coffee, a little water? Everybody's good? Okay. We're going to talk about short sales today. Who wants to take a stab in the dark and tell me what a short sale is? And just so you know, it has nothing to do with the length of time. So can anybody explain to me 5 seconds what a short sale is?
Sell the house for less than the loan.
Yes, that is correct. Selling the house for less than what's owed on the home. What is a short sale? Again, it has nothing to do with the length of time the sale takes. When a mortgage servicer/investor agrees to accept a discounted payoff in order to accommodate a real estate sale. In all cases, the value of the property is less than the amount owned. So, case in point, you have a home with a First and Second Bank of America. You're encumbered by about, let's say, $500,000. The market has declined. You now have a home that's probably worth $300,000. What do you do with that $200,000? Well, unless you can write a check for that remaining $200,000, you need to sell your home. We need to sell it by means of a short sale. And in a nutshell, that's basically what a short sale is. How does a homeowner benefit from a short sale? Well, number one, there's less of an impact on the borrower's credit. Number two, it helps eliminate their mortgage debt. And number three, if they do sell their home by short sale means, they can possibly qualify for Fannie Mae home loan in about 2 years with 20% down. Now, let's talk about the negative impact on the borrower's credit. I think we can all agree upon in the room that going the short sale route in most cases is probably going to be better than foreclosing. Is that a pretty much an agreeable statement? Okay, yeah. There is rare circumstances where it might be beneficial for a homeowner to go the foreclosure route, depending on who the banks are and if the loan was a purchase money loan, if it was a refinance type loan. But for the most part, a short sale generally is the better way to go. What you're doing is eliminating some of the mortgage debt. As you're in a declining market, the bank is losing more and more money. You're going to be owing more and more money to the bank. If we can, for the sake of words, go ahead and cap off that bleed at a certain point, what you're going to do is eliminate any further debt that the homeowner may incur. Okay? In your declining market, when you're doing your short sale, what ends up happening is obviously you're basically going to, excuse me, I'm a little bit of pain right now on my side. I pulled a muscle. You're going to go to the bank and approach them and say, okay, I've got a $100,000 loan, and at the proceeds of this sale, we're only going to have $50,000 left. Okay, you negotiate that with the bank. That's at the point where you're in foreclosure. As you move along down the line, what ends up happening is you're going to end up having a foreclosure if you don't short sale. At that point, the bank may say, well, we're going to go ahead and take it back, but now we're only going to get $25,000 as opposed to the $50,000. There's a $50,000 to $75,000 gap there where the homeowner may have to pay a deficiency, and that's how you're eliminating some of the debt. Point number three, can possibly qualify for a Fannie Mae home loan in 2 years with 20% down. If a homeowner can successfully short sell their home, Fannie Mae has certain programs right now where they may be able to qualify to purchase another home in 2 to 3 years down the line. Now, obviously, the guidelines now are going to be a little bit different 2 to 3 years down the line, but they certainly have a better shot at purchasing a home by going means of short sale as opposed to foreclosure. Why would a mortgage servicer or investor agree to short sale? Again, the short sale minimizes the loss in comparison to a foreclosure. And we kind of touched upon that. As you're in a declining market, the faster they can get rid of that asset, the faster they can do something with the home, that's going to minimize the loss that the bank is going to incur. Who is eligible for a short sale? Well, just about anybody who can prove a hardship on their personal income and anybody who owns a home. That includes homes that are owner occupied, investments, 1 to 4 units, and we're even starting to see a lot of commercial commercial buildings or apartment buildings that you can short sell. Borrowers whose mortgage debt is greater than the property value. Obviously, I think that's an obvious statement right there. If you're upside down, you need to sell the property. Yes, you can absolutely have the opportunity to try and get your short sale approved. Borrowers who are insolvent, debts outnumber their net worth, and their bills are more than their income. We all know the economy is kind of taking a dump on us. Most folks right now are in a bad situation where their bills are exceeding their actual income. That's also another qualifying hardship that the bank is gonna look at. What is the short sale process? Let's go in depth with this. Talk to a reputable, experienced realtor about your situation. So most of the folks in here, you guys are either just licensed or you're about to get your license. Is that correct? Do we have any seasoned agents in here? Most everybody's brand new, correct? To the industry? Okay. As you're moving along in your real estate career, you're going to go out, you're going to be door knocking, your sphere of influence, somebody's going to approach you and say, you know what, I think I have a potential short sale listing. They're coming to you as that reputable realtor. If there is a short sale option, you're going to list the property at fair market value. Now, a lot of problems that start out in short sales is the realtor will try and list the property at a price that would give the first and second or the first mortgage holder a full payoff. And it's not a bad idea to try that, but what ends up happening is you're wasting time, okay? If I have a home that's encumbered by, let's call it $500,000, and the home is only worth $400,000, but the homeowner insists that we list it at a price to give that homeowner, to give them a full payoff, what you're doing is you've already started a clock, okay? And if they've missed 2 to 3 months of payments, the bank is going to probably initiate foreclosure, okay? So that's why it's key to make sure that when you list the property as a short sale, that you're listing it at fair market value, today's current market, not at a price that's going to give them a full payoff. Now, obviously, there may be a circumstance where you can give them a full payoff, and it does have full market value. By all means, do it. But if the market value is not there to give them a payoff, all you want to do is list it at fair market value. And we'll talk a little bit more about that in just a few minutes. You're going to procure an offer near fair market value with a qualified buyer. Now, with short sales, we can sit here and we can run comps all we want. We can have a second person run comps. We may even be having appraisal done. But at the end of the day, the bank is going to start to dictate to you what they deem as fair market value by means of going out and sending a BPO agent out there. They may send an appraiser out there. They may send a multitude of a BPO and an appraiser out there. It's basically up to the bank's discretion and what their investor guidelines call for. But all you want to do is get on the MLS, comp out that area, try and make an educated guess on value, list that property, find an offer that is based upon market value, get that package into the bank, and let them make that determination if your offer is fair market, if it's low, if it's high, and that's where you start your negotiations. That brings us to step number 4. You're going to submit the offer with a settlement statement or HUD, the financial disclosure, which is basically a financial statement that shows what your homeowner's expenses are. So the financial form will show, this is my monthly income, this is what I pay in electricity, cable, TV, water, etc., etc. Whatever your monthly expenses are, that's what's going to be listed on the financial disclosure. The bank also wants to see the last 2 months of bank statements. They want to see what you're depositing into your personal bank statement, and they also want to track to see what type of spending habits you have. On numerous occasions, I've had banks tell me, Franco, I don't get it. These guys are spending $700 on a BMW payment, but they're not making their mortgage payment. What's the problem here? So just because you can prove a hardship to the bank doesn't necessarily mean that they will allow the short sale to move forward. They want to look at that individual person. That's why they're looking at pay stubs. They want to look at bank statements. They also want to look at your pay stubs. They want to see what you're saying on your financial statement. Does it really match with what your pay stubs are? They want to see the availability of overtime possibly. Okay? They may go back farther than 2 months and say, Well, let's see what he was doing 6 months ago. His hardship says that overtime's been cut. So let's see what he's making right now. So they're going to look at trends from that homeowner. Again, they're going to look at financial statement, bank statements, because they want to see what your income is coming in. There might be other sources of income besides what's on the pay stubs. They want to see your spending habits. They want to see pay stubs. Last 2 years' tax returns. We can look back 2 months on your bank statements and pay stubs, but they're also going to want to know what you did in the last 2 years as far as income is concerned. You're going to write a hardship letter. Now, here's the funny thing with some homeowners. They go to the bank and they say, Mr. Lender, I owe you $500,000 on this first, and we can only pay you $300,000. And we want you to write off $200,000. So they get a piece of paper and they write down, please consider my short sale. Interest payment went up. Thank you. Is that a hardship letter? But you'd be surprised how many times I get a hardship letter like that. We've always had a rule of thumb. Your hardship letter should be anywhere between, let's say, half a page to a full page. Okay? We want to know what your circumstances are. Kind of like who, what, where, how, and why, as we used to say. Okay? They want to know what happened with your financials. What were you doing before? What has happened? What are you doing right now? And if you're doing anything to try and recover from that financial hardship. They want to see a story. They want to see kind of a chronology of your story. Third-party authorization. You as the agents are going to be negotiating possibly on behalf of your homeowner. In my case, I am also an agent, but I'm a third-party negotiator. So you guys would approach me and say, Franco, I just picked up this listing. I need you to negotiate for me. So that's why we need third-party authorizations. And that's basically your meat and potatoes, as I call it. There's going to be other items that you're going to need to put together. Listing agreements, obviously the purchase contract once you have your buyer, buyer's proof of funds, pre-approval letter. Next step, wait way too long for the mortgage servicer and investor to approve the short sale in writing. Again, we said short sale has nothing to do with length of time. Right now, we're looking at length of time with banks anywhere between 30 and 60 days, let's say with the bank like Bank of America. Anywhere between 30 and 45 days with Wells Fargo, Chase. So every bank that you work with across the board is going to have different timelines that they're going to operate within. Once you've negotiated your short sale, you're going to send your package in. Some banks require you to do it through a system called Equator. Has anybody heard of Equator before? One person in the back, 2 people. Outstanding. That is Bank of America's platform for basically submitting the short sale package. Kind of the old way we used to do it, and it's still some of the ways we do it with some banks. You take a thick short sale package, about 100 pages. By the time you put those 2 years tax returns in there, and you put it in on the fax machine, you send it to the bank. Bank of America is a little bit different. They actually have you scan it in and upload the documents at certain periods of time. That is their Equator system. So you're going to submit that. They're going to order a BPO. They're going to order the appraisal. And what's going to happen is you're going to be assigned to a negotiator. The negotiator is going to look at the financial statement, hardship, all the characteristics of that homeowner, and they're going to take a look at the offer and say, your offer looks good, or your offer is a little bit low. We'd like you to go ahead and counteroffer them. And that's where you're going to begin your negotiations. Your negotiations can go 1 to 3 days. Your negotiations can go 2 to 3 weeks. Okay? It all depends on where your offer comes in. A bank tells you, well, Franco, I did my BPO and came in at $500,000, but your offer is $450,000. You're going to need to have that buyer come up. And then you start haggling with them. Well, I see your point. Your value's come in at $500,000, but did your BPO agent take note of the pool that's cracked and that's leaking water? Did they jump up on the roof and take note that the roof shingles are peeling away and there's water damage in there? And this is where the negotiations can get tough. This is the longest period. This can be the longest period of your short sale, is when you're doing the negotiations. But once you've wrapped up negotiations and you guys have come to an agreement on the purchase offer, then they're going to issue you a short sale approval. Step 6, study the verbiage in the short sale approval letter and consult a real estate or bankruptcy attorney and tax professional about the potential consequences of the terms therein. Your short sale will not be approved until you see it in writing. The bank can say, that looks good, it looks good, we're going to go ahead and send it. Your file is not approved. Your file is approved when the negotiator actually sends you a copy of the approval letter. What you're looking for in there is the type of language they're going to give you, whether it be release or settlement type language, and I'll explain that in a few minutes. Assuming the borrower decides to go forward, the real estate professional and buyer work toward the closing transaction in the time specified by the mortgage servicer investor. What that basically means is if I get an approval today, they're going to give me anywhere between 30, 45, and 60 days to close the transaction. And you have within that time period to close that transaction, or your short sale approval becomes null and void. Now, there are in many circumstances, the bank will extend the time period out. There is nothing easy about a short sale during the escrow process. The bank understands that you have hiccups along the way. But the one key element that I always tell everybody in the closing process is keep pushing forward so that when you get to the bank and say, you know what, I need 15 more days, I need 10 more days, they want a good explanation as to what you've done and why you need it. Well, Mr. Lender, we've gotten the inspection appraisal done. They've got full approval. They're just working on some conditions, and we had to go to the IRS and request a document. Okay, that's good. You made good forward progress. Granted, we'll give you another 10 days. So just remember, there's always an expiration. You want to try and get it closed within that time period. In some circumstances, if you don't close in that time period, the bank will charge you a per diem, daily per diem. So what ends up happening is the net dollars that they're going to receive from a certain offer, it's going to start inching up. And now you start coming into situations where you have a shortage. And now you have to start tapping into commissions in order to pay that shortage. So that's why it's always a good idea to make sure that you can close within that time period. And read the approval letter for yourselves. Don't just pass that approval along to Mr. Homeowner and say, here's your approval. Go ahead and call up escrow, and I'll see you in 30 days when I'm ready to collect my paycheck. No, you want to get in there. You want to read that approval. You want to know what you can and can't do. And you want to be involved every step of the way. Do mortgage servicers and investors always approve short sales? No, they actually don't. Okay? It's basically up to their discretion as a lender or an investor as to whether or not they will consider reviewing the short sale and whether or not they'll approve it. Now, you've probably heard me say a couple times servicer investor. Okay? Let me take a side note real quick and just explain to you the difference between the two. Can anybody tell me the difference between the two? I'll just ask that question. Okay, let me explain. A servicer is somebody like, let's say, for instance, Bank of America. They are a huge servicer. Okay, I'm sorry? BAC Home Loans, Bank of America. Okay, what they do is they service for a group of investors or an actual investor. When you're making your payment to Bank of America, okay, all you're doing is giving Bank of America that money. And what they're doing is they're going to take a small portion out for servicing the loan, but then they're going to take the remaining of that payment, they're going to give it to an investor. Okay? So that's why you have to understand that a lot of times Bank of America is not your actual mortgage holder. There's an investor wrapped up right behind there. Okay? In some cases, they will not agree to the short sale. Many times it's the second mortgager or an HOA lien holder that does not agree to do a short sale. Okay? If you have a first and you have a second and you have an HOA, all three entities have to agree to do a short sale. Okay? Though the first will dictate kind of the pace that that short sale will go, all three entities have to agree to do a short sale.
Even though the second is not going to get money?
Even though the second... They may not get money. Well, I'll be honest with you. I've never really come across a short sale where the first didn't allow the second to have some level of consideration. Now, the level of consideration may not be grand in the big scheme of things, but they'll give them some level of consideration. It's going to be basically up to you as a negotiator or as a real estate agent to go to that second and say, well, look, I know you're owed $100,000, but Bank of America says you can only have 3. So what do we... And that is, by the way, that is a standard number with Bank of America.
Who pays the $3,000, for example?
Good question, good question. So we have a $500,000 loan, okay? And let's say, for instance, it takes it with commissions and escrow fees, title fees, property taxes. Let's call it $50,000 in closing costs. That's what we will call closing costs. Commissions, escrow, title. What's left from 500? You've got 450,000. Okay, that's what we call the net proceeds of that sale. Well, now Bank of America says, okay, there's 450,000. Let's say they're the first. Okay, Bank of America says there's $450,000. We're gonna allow $3,000 to go to that second lien holder. So now what do we want from 250? We've taken 3,000. What is that? 247. So now, I'm sorry, 457. So they're going to take $457. They'll allow $3,000 to go to the second, and that's it. And that is a standard policy with Bank of America across the board since I've been doing short sales since 2006. And that is not going to change anytime soon. So, yeah, when you have a situation like that, it gets pretty tough. Here's where it gets a little bit more tough. When you've got an HOA that's fallen behind, and now you need to give them some level of consideration. In a case like Bank of America, they won't give them any consideration.
So the subordination clause doesn't mean anything in that?
What do you mean the subordination clause?
Yeah, let's say that I have a first and a second.
Okay.
And the second allowed the first one to be the main.
Okay. Okay. Yeah, no, absolutely. If they subordinated, now they've taken a junior lien position.
Right.
So in a case like that, that's part of the risk of doing something like that. That's why generally your interest payments, your interest on a second mortgage is generally higher than it is on the first because it's a riskier position in the event that the homeowner defaults and the home goes to foreclosure. So they're trying to make up for some of that money in the event there's a loss by charging them a higher interest rate.
So how do you know, we have servicers and the owner of the note.
Okay.
What happens if the note is lost? Because there are some cases where they don't know who has it.
Good question.
You deal with whom?
I'll be honest with you. So I've been doing short sales since 2006, done over 600 transactions. I just came across the first one like that. I just came across the first one. It was Wells Fargo, and they can't find it.
So what happens in that case?
In a case like that, you're going to take that on a case-by-case basis. You'll find somebody. What I ended up doing was I talked to the homeowner. I said, look, when's the last time your second contacted you? Well, it's been a year, Franco. Have you been getting collection notes or collection letters or getting phone calls? Yeah, but I disregard them. Why don't you open one up? They opened it up, and lo and behold, it was charged off or was sent over to another agency for collection purposes. But it took her a while to find that information, and it doesn't always update on the prelim or on the title report. The title report will just show who's there, who was originally there. But when the loan gets charged off or sent over for servicing to another company, title's not going to pick that up. That correspondence is sent directly to the homeowner. So that burden right there is going to fall on the homeowner in a case like that. Yeah, I need you to tell me who it is. One other way we've been able to find out who was running the credit report. The credit report will show who's trying to collect on that debt. So, but I've only had one case like that where they actually, nobody could find out where it went.
Yeah, because some of the notes were sold to China or maybe France or...
Yeah, it could have went to a multitude of companies, but in most cases they send it off to a collection agency. Anybody have ever heard of GC services? You ever had a ticket that you didn't get to pay or driving, you got pulled over? There's a company called GC Services. They're a company that collects for Bank of America and a few others. So there's tons of companies out there right now that are collecting, and they're just taking that debt on. They're just collecting for the banks. So good question. What does a short sale cost the homeowner? Generally nothing, okay? When a homeowner approaches you and says, I need to do a short sale on my home, there's no out-of-pocket costs to start that process, okay? It's very similar to a standard sale, but the exception is we have to go to the bank and have them approve that buyer and approve this transaction to move forward. So generally speaking, no, you're not going to have to come out of pocket. When short sales first got started, there was a few banks out there that said, well, we'll go ahead and review the short sale, but the homeowner has to pay for the appraisal. So the homeowners are having to come out of pocket with $350 to pay for an appraisal. But those days are gone and over. That lasted for maybe about 6 to 8 months, and that was a complete failure. But to start the process with the bank to have them review your package for a short sale, generally nothing. There is going to be cases where you have to do something called a cash contribution or a promissory note. So we go back to the point where Bank of America is your first, okay? And let's call it Chase second, okay? And Chase has a $100,000 line of credit. And these guys are tough. They say, no, Franco, we're not going to take that $3,000 that Bank of America has given us. We want more money. In fact, we want 20% of the unpaid balance. 20% on $100,000 is $20,000. So we've got $3,000 accounted for, but I still need to look for $17,000. In a case like that, that's a cash contribution. That is where a homeowner would have to come out of pocket and pay some consideration to the second lien holder in order to get them to agree to doing the short sale. Okay. Now you're probably saying, Franco, if my homeowner had 17 grand, we wouldn't be facing foreclosure right now. Well, I wouldn't be 3 to 4 months behind, right? Okay, well, you'd be surprised how many homeowners have $10,000, $15,000 put away, and we find out about it later on down the line. So that's why it's good to have a good, solid, strong conversation, obviously friendly, but a very open conversation with your homeowners in the beginning. I had a situation one day where a homeowner had 5 pieces of property, and he had only disclosed 2 of them to me. And not only did he not disclose to me, but he also didn't tell me that he had all those other mortgages on time. So I kept grinding the bank. For 30 days, I grinded Chase. And they sent it to a collection agency, and they finally said, look, we're tired of arguing with you, Franco. It's getting nowhere. I agree, we're getting nowhere. This is why we want this amount of money. Your homeowner, we just ran his credit report. He's making mortgage payments on 5 different mortgages for other pieces of property between here and Arizona. Picked up the phone, called him. Is this true? Yeah, I've got about $30,000 sitting in the bank. Well, you need to give me some of that money so we can give it to the bank. At that point, we're able to move forward. So those are rare circumstances, but again, generally nothing. The homeowner will never have to come out of pocket initially in order to have the short sale reviewed or considered. But there are going to be many cases where cash contribution is needed. And just so we're clear, it's not only to the second. It can also be to the first. If you have a case like Bank of America first and second, they may say, we want X amount of dollars for the first and we want X amount of dollars for the second on a cash contribution. Generally speaking, it's the second who wants a cash contribution, but I don't want you to get stuck on that. First can ask for it as well. How long does a short sale usually take? Well, we mentioned that a little bit earlier. My partner uses this short sale slide, and he had up there, I think, 5 to 9 months. I think we can knock that down anywhere between 2 to 4 months. If you wanted to write this information down, I can give you some of the top banks right now and some of the time frames that they're working with. So if you're dealing with a bank like Bank of America, they're running about 60 days right now, and that's through the Equator system. They were doing well about 30 to 45 days. They changed the Equator system. It's making things long again. So they're running about 60 days. Wells Fargo right now is probably running at about 30 to 45 days. Chase, and including WAMU, where when they took them over all of that portfolio, you're probably looking at about 30 to 45 days. GMAC, 90 days plus. Let's see, Green Tree Services, they're probably a second, most popular in second position. They're running under 30 days. Anybody heard of Wachovia? Do you remember Wachovia, which is now Wells Fargo? They actually put together a really cool program. It's called Fast Track, and it's still in existence. They were giving me approvals in about a week and a half, which wasn't bad. Just about zero documentation. A phone call to the homeowner, what's your hardship? Okay, sounds good. Franco gave me a purchase contract in HUD. They looked at it, you're approved, close escrow. No documentation, no pay stubs, no bank statements, no tax returns. So when you're coming across those homeowners and you're knocking on doors and who's your lender? It's Wachovia. That's one you're going to get paid on pretty quick. So I see a lot of smiles in the room because everybody knows these things take a long time. I'm sorry? Good question. That is all negotiated during the process when you're talking about purchase price and what's going to be allowed and not allowed. Most of the banks now are allowing 6% commission for the most part. Okay, total commission, not to one side, total commission. Bank of America does allow 6%. In some rare cases, they'll start to knock it down to 5, even 4%. The rule of thumb with Bank of America is once you surpass the $400,000 mark, you can expect your commission to be knocked down. You're doing a short sale that's $1 million, they'll probably knock you down to 4% commission. Okay, the bank figures, okay, that's total commission. Yeah, so 2 and 2, or however it is you want to break it down. The bank's theory is if I'm going to do a short sale, if they're doing a short sale on $1 million home and they're taking $500,000 loss, why is it, especially a second? These guys are walking away with $10,000, $12,000, and the agent walks away with $50,000 in commission. They're like, no, we want some of that money. So that's when it gets a little bit tough. So the higher the purchase price, generally speaking, your commission will start to get knocked down. Chase has a standing rule. Anything across the board right now is 5%. HFC starts off at 5% and knocks you down to 4%. Was there a question back here? Did you have a question?
No.
Okay. Okay. I'm sorry, did you have one?
No, it's the same one.
Oh, okay, perfect. Yeah. So your commission, you can get 6, but you're looking at 4 and 5 in some rare circumstances. Okay. How long does it take for a home to be foreclosed on in California? I don't remember. Kartik, is this gone over in the books?
A little bit.
A little bit? Okay. So, all right, let me try and elaborate on this. When a homeowner starts to miss payments, they're considered to be in default. Okay? You're defaulting on your home mortgage. Most lenders will wait to initiate the default process or the foreclosure process here in California after about 2 to 4 months. So if Mr. Homeowner has missed 2 to 4 months of payments, they're going to get a letter from the bank and saying, we're going to go ahead and initiate foreclosure. They file a piece of paper called a notice of default with the county recorder, and that's when the time clock starts. Okay, that's your 90-day mark right there. Okay, notice of default is filed. You now have 90 days to take care of the problem before they file a notice of trustee sale. During that time period is where you start negotiating with the bank. How do I catch up with my payments? You borrow from mom and dad. They make you current. That's that time period that the bank wants you to start figuring out how you're going to go current with them. Okay. After 90 days, the bank says, well, you haven't done anything to correct a problem with us. So now we're going to escalate this to the next level. Now they're going to file something called a notice of trustee sale. Again, that's filed with the county recorder. Once it's stamped, it's official. That day that they stamp it is the day your notice of trustee sale is actually filed. Okay. At that point in time, you have approximately 21 days to take care of your defaulted payments, at which point the bank can then foreclose on the property. Okay. You'll lose your property one of two ways through the auction. They're going to auction it off at the courthouse steps, or they're going to make an attempt to auction it off. One of two things will happen. Either an investor will buy it right there at the auction on the spot, or it goes back to the bank, and they'll call it back to beneficiary. The bank is the beneficiary. Okay. At that point, if it goes to auction, the home is lost. The homeowner has officially been foreclosed upon. Okay. After that time period, if the bank takes it back, going back to beneficiary, then they're going to give it to a local asset manager, and that's when they sell it as a REO, real estate owned property. I'm sorry? No rescission. No rescission. Moving on. Will a borrower be responsible for the deficiency balance, forgiven amount after the short sale closes? That's a very good statement, or a good topic to talk about, and let's talk about it. I mentioned earlier that you're going to be negotiating, you're going to be talking about purchase price, what's allowed, what's not allowed, and then you get that magic letter that says your short sale is approved. But before we send it off to the homeowner and get excited, we want to read the language that's on there. Okay? There's two types of letters that you can receive. One that has release only, or the secondary one would be fully satisfied, full satisfaction, fully settled. Either way, you've got two types of approvals, and let's talk about what each one represents. With release-only language, what ends up happening is the bank says, okay, Mr. Homeowner, we're going to go ahead and accept the offer on your property in the amount, let's call it $500,000 again, okay, with net proceeds to us of $450,000. But you will still remain liable for the remaining balance, what we call the deficiency. In a case like that, you're looking at release-only language. Okay, most first lien holders right now in California are giving full settlement language, so you won't see the release-only verbiage on there. They're basically going to say, of the $500,000 sale, we're going to take the $450,000 as proceeds, and we're going to take that as full settlement. You'll never hear from us again, and have a great day. Now, there's a law that was just enacted this year. It's California Civil Procedure 508E as in Edward. Again, California Civil Procedure 508E as in Edward. And that basically says that a senior lien holder who agrees to do a short sale with the homeowner in California has to basically agree to give them full satisfaction or full settlement language. And they will not have the recourse action to go after them for the deficiency language. And the great thing about that particular law that was enacted is not only does it apply for owner-occupied properties, but it also applies to investment properties as well. Okay? It's basically a dwelling 1 to 4 units is basically the way the law reads. So it's a great law that was enacted this year. Again, it's 508E. It's also known as SB 931. Again, SB 931. In a case with release, you're probably going to see that more along the lines of the second. Can anybody take a guess why the second would want to have that release language in there? I'm sorry? Not necessarily. Let's think. I'm sorry?
They send a 1099, right?
Both lenders will send you a 1099. But here's why the seconds are more prone to give you release-only language. Who got the bulk of the net proceeds? The first. Who's taken the bigger loss? The second. Okay, so who's more likely to want to go after the homeowner after the short sale? The second. That's why you only see. Well, you can negotiate with the bank early on before they cut the letter and say what they're going to give and not give, and tell them, look, I know you're only getting 3. My homeowner's going to come in with another 3, but I need full settlement language. I don't want you guys coming after the homeowners. Okay, so you want to be presenting that to the bank while you're in the negotiation phase of your short sale. Okay, you don't necessarily want to see the letter and then have to go back, because that takes an extra long time. What you're going to need to do is get that done early on. Okay, yeah.
But if you get a 1099, assuming that you get a 1099 from the second, isn't there a protection under the federal tax law?
I will talk about that a little bit later on. There is a slide in there, but let me make one statement to that though. Please understand that the bank will issue you a 1099, whether they're first, second, third, or in the case of Newport Beach, even the 6th lien holder. Okay, they will issue you a 1099. By law, they have to. IRS tax law says they have to issue a 1099. Now, there's 2 types of 1099s that can be issued. Okay, in the case of a short sale, you're going to get what's called a 1099-C. C meaning cancellation of debt. Okay, if a home got foreclosed upon and the homeowner took no action to try and do a short sale or loan modification, the bank will also issue a 1099, but that's going to be called a 1099-A for abandonment. Okay, so just so we're clear, the bank will always issue a 1099. Now, depending if it foreclosed or got short sold, it'll be either an A or a C, but either way, they get a 1099, and all lien holders will issue that. Okay, now one other quick thing to add into there. I've had a couple of homeowners approach me and say, Franco, guess what? I didn't get my 1099, so I don't have to deal with it. Wrong answer. Just because the bank didn't issue you the 1099 just simply means they forgot, but you are still responsible to contact the bank and say, hey, I didn't get my 1099. I need you to send that over. Okay, so you're still liable. Now, the deficiency balance that's owed is completely different from the tax ramifications or the tax liabilities. Okay, we'll talk a little bit more about that, but I just want you guys to be clear that the tax liabilities are absolutely different from the deficiency language. They do relate to the same amount of money that's sitting there, but 2 different issues. Okay. Is California an anti-deficiency or a non-recourse state? Yes, non-recourse debts include purchase money loans and rate and term refinances on a primary residence, 1 to 4 units. Some home equity lines of credit are considered non-recourse loans when they are used to purchase a primary residence. Here's the way to remember it. Okay, if it's purchase money, it's non-recourse. If this gentleman went out and bought a home, and he got a First and Second Bank of America, and he ends up getting foreclosed upon, or he ends up having to do a short sale, because he is short, he still has the original purchase money loans. Those are considered non-recourse. Now, if this gentleman goes out and buys a home 2 years later, he goes and refinances those loans, and now he has a new loan on the home. That's considered a refinance, obviously, but now it's considered recourse debt. Okay, so yes, we are non-recourse, but it depends on the types of loans you have on the home. Is it the original purchase money, or is it refinance? Exactly. Lines of credit can be non-recourse, but only in the case where the money was used to purchase the home. If they took any money out and bought a fancy sports car or a fancy boat, some Sea-Doos for the summer, then now it's not considered non-recourse because they took money out. The money has to strictly be used for the purchase of the home. Does a homeowner have to pay taxes to the IRS on the forgiven amount? The mortgage investor is required, again, to send the borrower a 1099-C for the forgiven amount. The forgiven amount is considered income to the borrower. However, 2 major exclusions exist. So here's what you were talking about. Again, who's going to send you a 1099? All the banks or just some of them? All of them. Okay. If they forget to send you one, are you still liable? Yes. Absolutely. Okay. First exclusion is HR 3648, the Mortgage Forgiveness Debt Relief Act. This was the one that President Bush signed right before he went out of office, the Debt Relief Act, okay? And that basically says that under HR 3648, if the amount forgiven was on a mortgage loan that was used to buy, build, or substantially improve your primary residence, the borrower will not have to pay taxes on this amount. And that's going to expire at the end of 2012. It already expired once and it was extended out. Please consult a tax professional about the specific details of this exclusion. So as real estate agents, our scope of duties are just restricted to real estate. When we start getting into IRS tax laws, that's when you want to tell this homeowner, this is what I know exists, but you need to take this information, present it to a CPA or a tax attorney, and have them explain this law and how it pertains to your individual situation. So this is one of the exclusions. The next exclusion is, does anybody need to write that down before I move on to the next slide? Has everybody got it? Okay. The second exclusion is going to be 108A1B. Under 108A1B, a borrower may not have to pay taxes to the IRS on the forgiven amount if they are deemed insolvent at the time of debt discharge. This is not a real estate specific exclusion and is not restricted to a borrower's primary residence. So basically, do your bills exceed what your income is? That's basically what this law is talking about. In most cases, that is the case with any homeowner who's having to do a short sale. So in almost all cases, this is going to apply. But again, it's not for us as real estate agents to make that determination if a homeowner falls into that category or not. They need to seek the advice of a tax professional. Can a distressed homeowner initiate a short sale as a backup while waiting for a loan mod to be approved? Huge problem we have in the industry right now. A homeowner says, I need to do a loan modification. I can't afford this payment. My interest rate went up. I'm losing my job, whatever the case may be. They initiate a loan mod, okay? And I think if you followed the news enough and you followed the real estate industry enough, loan mods are taking a long time and a lot of homeowners are getting frustrated, okay? Homeowner goes to the bank and files a loan mod. In a loan mod, they don't necessarily need a real estate agent. They're not selling their home. They're just modifying their payment. They don't need me as a negotiator to settle their debt. They can do it on their own. They go to the bank 3 months, 6 months, 9 months. I have a case 18 months down the line and still no resolve on the loan modification. So the homeowner gets frustrated and calls you up as the agent and says, I want to short sell my house. One of the first questions you should be asking is, have you initiated a loan modification with the bank? If they have initiated a loan modification, red flags should be going off in your mind saying, well, technically we can't do a short sale yet until they cancel out that loan modification. So basically what it comes down to is a lender will not allow you to have both options reviewed at the same time. You either have to do a loan modification or a short sale. Okay? And you'll be surprised how many times a homeowner forgets to disclose that to you, and we're over here trying to push our short sale through and trying to figure out why isn't this thing going through. Come to find out, a homeowner initiated a loan modification. Okay? Yes?
So, during the short sale, say like it takes like 90 days or maybe 180 days.
Mm-hmm.
Will the homeowner during that period of time, do they need to pay the rent? I mean, their mortgage for the bank?
Good question. You have to be very careful how you answer that. Okay? I think what you're asking me is during the course of a short sale, is a homeowner obligated to make their mortgage payment? Okay? Let me give you some information on that. In some cases, a lender or an investor will not allow a short sale to be reviewed if a homeowner is current on their payment. Okay? And you need to have your homeowner call the bank and find out, hey, I'm getting ready to miss my first payment, and I don't want to be one of those guys that's waiting till the last hour. What are my options? Can I do a loan modification? Can I do a short sale? And they're going to tell you, well, at this present time, you are current. So the only option available to you is a loan modification. Well, when would a short sale be available to me? Well, we don't consider short sales until after somebody's 60 days late. Okay? Now, if we have that information, by law, we are not allowed to tell a homeowner, hey, I need you to miss that payment so I can submit that short sale. You'd be surprised how many people tell homeowners that. It's illegal to do that. Okay? So what you want to do is basically present that information to them. They need to make that decision consciously on their own, whether or not they want to miss that payment or not. Did I answer your question? Did you have another question, sir?
Yeah, do you need the denial letter for the modification in order to start the short sale?
You don't necessarily need to have a denial letter. If a homeowner is just getting frustrated with the loan modification process and they're done with it and they just want to move out of the house, you absolutely can just move forward with the short sale. But the homeowner does have to call up the bank and say, hello, Mr. Representative, this is Mr. So-and-so. I want you guys to cancel my loan modification. I've retained a listing agent, and we're going to go ahead and short sell my home. And the bank, in most cases, needs to hear it from the homeowner or have them just sign a quick statement and fax that in. But the loan modification has to be canceled in order for the short sale to proceed forward. In some cases, you'll have a homeowner that starts a short sale with you, and then they have second thoughts. And they say, you know what, I want to do a loan modification now. You'll have that happen a lot. That's why it's a good idea to constantly communicate with that homeowner. And you need to let them know, hey, if that is going to be your wish later on, you need to let me know. Because what will end up happening is you got this loan modification short sale they're trying to go through, and they didn't tell you what they did, and now everything's placed on hold. Because the bank's trying to figure out what's going on, and they're not communicating with you.
What is the position of the lender when you tell them that the homeowner is planning to file a BK 13?
What is the position of the bank?
Yeah, let's say that you have a statement.
Okay.
And, you know, you tell them, hey, if we don't do it this way, this guy is going to file for a chapter.
You mean kind of use it as a threat?
Right.
The bank will say, okay,
They don't care.
have them file it. Have them file it. Which leads me to kind of a side question here. Banks will not allow a short sale to be reviewed, much less a loan mod to be reviewed if a homeowner is in bankruptcy. Okay? So know that if you're going to throw that out there at them, what they'll tell you is, okay, the minute they file the bankruptcy, we stop negotiating because they can't. The home is included in the bankruptcy. How are we doing on time?
15 minutes.
Okay, no problem. Yes.
On your HR 3648,
Yes.
little clarity.
Mm-hmm.
A couple buys a home 30 years ago for $100,000.
Okay.
They sell it next year in 2012 for $1 million. The tax deduction for the couple is $500,000, which means they're still liable for $400,000, right?
Under 36, when did they buy the home?
30 years ago.
Okay, they probably wouldn't qualify for 3648. Okay?
Why not?
Because under 3648, they had to buy the home during a certain time period.
What time period was it?
You should probably look that up. Don't quote me on this, but you may probably be going back as early as maybe 2002, 2004. But it's definitely something, and they may have changed it when they extended the law out.
I'm trying to figure out where does it, why and where does it apply? I mean,
It may not apply in that case, but
well, even for people who bought homes in 2000 or 2001, why would
during that time, let's look back at the way the market was. Before the market started to take a dump on us in the end of 06, 2002, 3, 4, and 5, people were getting loans 100%, no income, no assets, right? We call them ninja loans, no income, no assets, CISA, whatever they had those acronyms for. So that law was supposed to be applied more for that time period of folks that were buying homes. But you can go onto Google search HR 3648, and it'll actually give you the criteria, and you'll know whether a homeowner meets it or not, doesn't meet it. But again, that's something you want to put in front of them, have them kind of do that discovery on their own, and then have them consult a tax professional on something like that. Okay. Government, President Obama started a program called Making Home Affordable. Under Making Home Affordable, he has two programs, the HAMP program and the HAFA program. HAMP is for loan modifications, and HAFA would be for short sales. So the bank has their own guidelines in which they review short sales and what they'll allow and not allow. And then they also are, most of the services right now are participating in the HAFA program. Here's some of the cool things about the HAFA program. Borrowers can receive up to $3,000 in a relocation incentive. Okay, when you're doing a regular short sale or what we call a proprietary short sale with the bank says the homeowner gets zero proceeds. They cannot profit from the sale of the home. If there is no equity and the bank is taking a loss, then they do not want the homeowner taking any type of incentive or any type of equity in the home. Okay, under the HAFA program, they will allow the homeowner to have $3,000 of the net proceeds. And it's basically said it's used for relocation assistance. Homeowners don't have money to move out, hire a moving truck, moving storage area. That's what that money's to be used for. Short sales gain a uniform and streamlined process. This is true. With Bank of America, Wells Fargo, they're all running about 30, 45, 60 days. With the HAFA program, when you look up the HAFA program, it'll tell you in the first 30 days, the bank needs to do this. The next 30 days, the bank needs to do this. And the next 30 days, you need to do this. So there's a uniform process, and it doesn't matter what bank you're working with. If they're participating in HAFA and the short sales being reviewed in the HAFA program, they all have to participate with these guidelines that have been set up. So it doesn't deviate from one bank to the next. The guidelines will be the same. You have a question?
Regardless if that file came from him and it went back to short sale because the borrower was in default again.
Mm-hmm.
Remember, in the loan modification, there's 3 trial payments and more.
Right.
And then the borrower can't afford it because they just have to comply, but the income is not sufficient.
Okay.
So now the borrower decided to just let go through short sale, and it falls into the HAFA program.
Correct.
So question now is, can they still do that? Go to HAFA after him?
Yeah, absolutely. Absolutely. A homeowner can try HAMP, get denied, do the regular loan modification, get denied, then try a HAFA short sale. If they get denied there, they can try a proprietary short sale. So there's actually 4 different types of programs that they could potentially try. If they're
They can also go back to HAMP again?
Well, if they got denied in HAMP, which is the modification program, and then they go to the HAFA short sale, chances are they probably won't let them be reviewed in HAMP again, because they've already said, you're one shot. You don't qualify. You can try and go back to a regular loan modification, but probably not back to HAMP. And that also goes true with the HAFA short sale. If they got reviewed through the HAFA and they were denied there, then yeah, absolutely, they'll just say, you know what, you're just going to have to go through the regular short sale process. And that also holds true if you don't complete the transaction in time. I just had a transaction last week. The buyers, they took up to 60 days, and they still were nowhere near closing. The bank told me, Franco, you're done with HAFA. We're pulling you out. We're putting you in the regular short sale program. So my sellers lost a $3,000 incentive. So that holds true on HAMP and HAFA. It was extended out, exactly. I bought some time, but I don't get the incentives of HAFA. Okay. Loan servicers and investors predetermine the list price. So this is the cool part about HAFA. Instead of listing the property, trying to find a buyer, having your homeowner collect all their documentation, now you go to the bank and say, hey, we're going to start the process now. I don't even have a buyer. I want you guys to do your appraisal. I want you guys to tell me what to list this property at. I want you to tell me what the value is going to be, so that there's less haggling back and forth or negotiating on what the offers come in at and what they deem as value. Okay, so it basically gives you the ability to start the short sale process before an offer comes in. Okay. Yeah.
That's the HAFA program.
That's the HAFA program. And just so we're clear, there are a few banks that have their own in-house programs where they may allow you to start the short sale before having an offer. But generally speaking, across the board, the bank wants to see an offer, a HUD, and a full short sale package from your seller before they'll even start the process. With HAFA, you get to start it without having an offer. And almost zero documentation. There's a small RMA packet that they call Request for Modification Assistance. Fill it out 2 to 3 pages. Send a hardship letter, send it to the bank. HAFA program starts.
They still give you
How do you know if the bank can?
I'm sorry, hold on. The commission, you're not guaranteed 6%. You're not guaranteed. There's a higher probability, but you're not guaranteed commission on that. Question?
How do you know your bank does that?
You call them up and ask them. You can have the homeowners call them beforehand, so you're not trying to get a package together and find out at the last hour whether they'll participate or not.
Right.
But I would say most of the banks, most of the major servicers across the board are participating. Aurora Home Services, Bank of America, Wells Fargo, Chase, GMAC, those are all big servicers. City Mortgage, they're all participating. It's when you get to the second liens that they're kind of 50-50, and I'll get into that in a few minutes. Investors waive rights to pursue deficiency. That was the other big selling point to homeowners if they went into the HAFA program. Before, the bank didn't have to guarantee giving you full settlement language. In the HAFA program, if the bank chooses to participate in HAFA, then they have to give you full settlement language. Okay, so you don't have to worry about deficiency language later on down the line or a bank pursuing you for the deficiency. But you will still get the 1099. The 1099 will still come, whether it's proprietary short sale or if it's the half short sale. Okay. Loan servicers, investors' participation is voluntary. This is not a law that President Obama passed and said the servicers or lenders have to participate in. It's voluntary. But if they voluntarily participate with a homeowner, there are incentives that the government gives the lenders. So that's the incentive for participating in the program. What about junior liens? Well, second mortgages, junior liens can receive up to 6% of the outstanding loan balance and $6,000 in total in exchange for releasing their liens. Optional participation also. Okay, so in a case like we talked about, Bank of America first, Chase second, extremely hard combination to deal with. If you can, more than likely you'll get Bank of America to participate in HAFA. Now your challenge is getting Chase to participate. Okay, and believe it or not, there are more second lien holders that are participating now, including second liens that have been charged off to collection agencies. I've done a handful of them already. I'm going to do HAFA. Will you participate? Okay. Now you understand that you're only going to get $6,000. You have to give my client full settlement language. And here's the other two big things. You cannot ask them for a cash contribution, and you can't ask them for a promissory note. And that's part of the cool, one of the cool things with the HAFA program for the homeowner is that not only do they get $3,000, they get full settlement language, and they're almost guaranteed that they won't have to pay a cash contribution or promissory note. And this is why it's so hard to get second lien holders on board with the HAFA program, because they basically have to say, okay, I'll take $6,000, you'll never hear from me again, even though you owe me $200,000, $100,000. So it's really tough to get them to participate. But again, believe it or not, I'm seeing a lot of seconds who have charged off to a collection agency. They're just saying, you know what, give me $6,000. I'll take my incentive from the government, a couple of thousand, and we'll call it a wash. And they're gladly doing it right now. So it was tough when the program first came about, but they're getting a lot better. Questions? Questions?
What's the incentive for second mortgage,
from the government? I think it's anywhere between $1,500 and $3,000. It's not much. It's a couple of $1,000s. But it's basically a way for them to say, you know, we're not going to spend all this money, time, and effort trying to collect this debt. I'm going to take $6,000. I'm going to take a few more grand from the government, and we're done. Let's get it off the books, and let's move on to something else.
3 minutes, right?
Okay. Distressed homeowners are looking for agents with knowledge and skill to help them through the short sale process. Here's to your success. Okay. Take this information that I've given you, run with it. Does anybody have any questions regarding short sales? Yes.
So could you talk about the risk of the buyer who buys the short sales?
Risk of a buyer? It all depends. With the buyer, I'll be honest with you, I haven't really come across a risky move that a buyer's made. Probably just one time where they consciously said, you know what, we're going to go ahead and start putting some work on this house before they were approved. Kind of a sketchy move on the buyer's part, but I understood they really wanted the property and they needed certain repairs to be made in order for that loan to qualify. In a case like that, that was a risk. That was a risk they took. Okay?
The short sale for the seller's lender disagree that it's not allowed the seller to give it back to the property, but the buyer seems like because during the transaction they know each other, they are agreed. So since I'm buying the property for investment, and then you need a house to live, right? And then the buyer probably disagrees. The seller will living there. So what is the risk for the buyer to letting the seller living there?
From the bank's perspective, correct? Or from even their perspective. So if I understood your question, basically you have a scenario where you have a buyer who comes in, purchases the home, and now they want to rent back to that home, to that seller they just bought it from.
But the seller lender is already, if the seller already signed some agreement, they cannot go living there. They have to evacuate.
Okay, if they sign something called an arm's length transaction affidavit, it's probably going to have something in there that says that the buyers and sellers have no prior written agreement, or there is no relationship, whether it be personal or business. And if they violate that arm's length transaction affidavit, what could end up happening is after escrow has been closed and the bank gets wind of it, they can actually rescind the transaction They'll send escrow back the wire on the funds and they'll say, we're rescinding this. Approval is null and void. We're going to rescind out that grant deed and we're taking the home back. This is not a complete transaction. So I'm going to...
The seller's the vendor will take it back.
The seller is going to go back on the grant deed, and the bank is going to be in control again until you find a new buyer. And at that point, they may just say, you know, we're just going to go ahead and escalate the foreclosure and take them right to foreclosure and not review a short sale again. So, okay, I'm going to stick around.
Thank you, Franco.
Got my information there.
Yeah.
Thank you. Appreciate it.
We have our next speaker is wonderful, Steve Cantu from Fidelity Bank, talking about commercial loans, debt service coverage ratios, how to buy apartment buildings, how to buy industrial buildings for an investment, SBA loans if a business owner wishes to buy their own building. So we'll be talking about all that. We'll take a quick 2 or 3 minute stretch break. And then I also have, all of our speakers are obviously great. If you want to opt into their email lists, I have just a thing where you allow us to give them your email address if you want to opt into their newsletters and stuff like that. So we'll take that on a case-by-case basis. So there's something here just to fill out in terms of who you want to continue to contact you. So
Franco, who's your toughest?
we'll take a